Hi, I'm Andrea Carpenter, and I'm a financial advisor here with Prosperity Partners Wealth Management. And we just want to take a moment and talk about some of the factors that we're seeing that are causing and have played a part in the volatility of the markets. We have had a rough start this year in many more ways than one, not just with stocks and bonds, but also with the war in Ukraine, supply chain issues, COVID lockdowns, and fears of recession, and a lot of factors. One of the things that the market doesn't like is unpredictability. And with so many different factors at play, we do see some unpredictable things at hand. But once we begin to break those down and understand them, it makes those factors and influences much more understandable and helps us make better decisions with regard to our investing. We want to talk a little bit about where we've been so far. Year to date, the major indexes are all down, with the Dow through yesterday down 13.7%. The NASDAQ already in bear territory, which is less than 20% drop at 26.5% on the negative side, and the S&P year to date at negative 17.6%. Historically, bear markets are centered around recessions, and the S&P 500 index closing in on that 20% barrier, but it doesn't have to be. It did so in 1998, in 2011, and 2018 without an ensuing recession. And one of the things that have played into this have been the Federal Reserve, inflation, and those factors that we've seen influence in the market. Let's talk about the Federal Reserve and what changes we've seen there. The Fed has hiked the federal funds rate by 50 basis points to 0.75 to 1%, with the first 50 basis points rate hike since 2000. Now, that may not seem like a lot, 50 basis points or 0.5%, but since it's the first one since 2000, it did come with a bit of a shock. The Federal Reserve has also begun to shrink its balance sheet. That's something called quantitative tightening. And in the next 3 months, they intend to allow $95 billion worth of maturing treasuries and mortgage-backed securities to run off the balance sheet. In all likelihood, the Fed is set to increase rates another 50 basis points in June and then again in July. And they've not talked about raising 75 basis points, which many in the market felt like they should. That's one of the reasons we did see a little bit more pullback than expected. What we've seen so far is very akin to what we saw in 1994. And initially, the market tends to view increases in interest rates as favorable. In fact, for stocks, higher rates often translate to higher returns. In many cases, a year afterward, the indexes are positive, and only once in the last several years, since 1994 to be exact, stocks outperformed a year after those increases began. But this isn't 1994. This isn't 2018, when we saw the Fed begin to gradually put rate hikes in its path. For right now, it seems as though the Fed is comfortable with the increases that they've made and using those tools at their demand, such as quantitative tightening, and tightening those monetary screws, so to speak, in hopes that to moderate demand reduce the number of jobs openings without significantly raising the jobless rate, and reducing that and slowing economic growth to bring things back in line with supply and reduce wage pressures, and also then slow the growth of inflation. So that's their goal, and they're using some of these instruments and things at their disposal. And in doing so, Chairman Powell, head of the Federal Reserve, thinks we'll have a soft or a softish landing or outcome because of this. And the Federal Reserve only has so many tools at their disposal, and they don't control everything. They don't control oil production. They don't control wheat harvest or wars or supply chain issues. But those things that they can control, they feel like they are using them to their best advantage. Let's talk about inflation, because that's something that's on everyone's mind, especially when you go to the grocery store, when you go to the gas pump, when you buy anything. Consumer price index information. April was a bit disappointing, but there were some key positives in those numbers. And the inflation didn't rise quite as much as expected. The consumer price index actually slowed from 1.2% month over month in March to 0.3% in April, but it still did top the consensus of 0.02%. Year over year, the consumer price index slowed from 8.5 to 8.3, but the consensus target was 8%. So the core consumer price index, or inflation, looks at food and energy, and that rose 6 basis points ahead of a 4 basis point estimate. Anytime it's above the estimate or it doesn't meet that estimate, that's when we see the market tends to have a reaction, even though you can see it's not a large increase. Year over year, the core CPI did slow from 6.5 to 6.2, but it still was above the estimate. For the consumer, there is some good news. People are still spending, and after the peak in January in consumer prices, those figures have fallen. And even though a rising annualized rate of 2%, it has still been slowing since January for consumer goods. What has been increasing? Services, rent, gas prices, those types of things we've seen increase dramatically. Food has increased almost 10% versus a year ago. And while energy prices in April fell, in May we're touching new highs with an average price of gas of 4.49%. Here locally today, I saw prices ranging from $4.15 a gallon to $4.29 a gallon within just a few miles of one another. So what do we do with inflation and spending and staying ahead of that? Another key indicator that we look at is credit conditions. How easy is the flow of money? And so far, we are in good shape for monetary credit and monies released. Anything above a 0 suggests that we have average financial stress. And in January of this year, that stress reading was almost -2. So as far as getting credit, being able to get and use and look at how money flows in our economy, that has not been a concern. Even with the Fed's raising interest rates, current financial conditions are still encouraging. They're not restrictive to business or economic activity. The other big question on everybody's mind is, are we going into recession? And Where are we with real income, real spending, and real cost of living? The real inflation adjusted consumer spending has been up 6 out of the last 8 months, including 3 consecutive increases through March. And that's the last information that's been available to us. So consumers are relying, at least in part, on cash that they saved that they didn't spend during COVID. Some of it's stimulus money, some money's from not being able to take trips and not being able to go places, and consumer savings actually increased. So disposable income has actually been down 11 out of the last 12 months. So while income is up, it's not been keeping pace with inflation. So the real consumer price index or the real spending index, that could be putting some brakes on spending. Consumers, the good news is, do have cash and do have cash to make those purchases. Wages have been increasing, and the latest data in April reflects solid growth, and there have been even upward revisions in March. In part, higher prices are pushing up sales in retail sales, just not adjusted for inflation. But it appears that consumers are tapping some of those savings for higher fuel costs. So you can see that there has been a big trade-off here, caused a lot in part by supply and demand and those supply chain issues that have come about. So looking ahead down the road, there have been no shortage of recession shocks, but remember, the average recession tends to last much shorter than those expansionary times. If you would guess, what would you think the odds are for a recession according to the latest Bloomberg survey? With all the market and inflation talks and the Federal Reserve talks and everything that you see going on, would you expect it to be higher than 50% or lower? It's actually 30% according to the last survey. That's the odds of a recession over the next 12 months. The federal funds rate, between 75 and a 1% basis point, those are still very stimulative. And you think about interest rates over a long period of time, and we're still in a very low interest rate and accommodative interest rate environment. The leading indicators are not pointing us to recession. And the yield curve, the bond yields, we've not talked a great deal about that, but those have not been showing those trends that tend to mean that we are going into recession. And there doesn't tend to be an inversion. The consumer remains strong even with the pricing increases. There are headwinds out there, and there are things that aren't keeping up with inflation and oil prices, incomes, etc. But those are the things that we have to look at. And one of the big factors that we want you to think about is how each of these things play into your own individual circumstance. When we're looking at a bull market versus a bear market, is your money invested for the long term, or is it invested to be used in the next 3 to 6 months? Are you concerned about some of those market downturns and what they're doing to your portfolio? We want to hear from you and answer those questions and help you understand how it relates to your specific situation. I've talked in general terms about some of the things that are impacting the economy to try to help us understand what those factors are, because with information, we believe becomes power. And with that, we can make better informed decisions. So please, if you have questions about your portfolio, if you would like a second opinion, we always do that consultation at no cost to help you understand what things we see that you've done well, what things you could improve upon and do better, and what factors and risks can we help mitigate that you may be taking unnecessarily? Thank you for your time and attention, and I hope this has been useful.